Good afternoon, ladies and gentlemen. Welcome to the Singapore Pavilion here at COP29 for our Finance Day program. I'm Surin, and I'll be the host for this afternoon. We have an exciting lineup of programs in the afternoon focusing on innovative solutions to mobilize private capital needed for climate action. We will demonstrate progress in two key areas, made by Singapore, blended finance, and also transition credits. To kick off our afternoon, we are diving straight into the first session, which is unveiling the future of blended finance. Hence, here, we will hear about updates to our Financing Asia Transition Partnership, or FAST-P or short, which was first announced at COP28 to pool concessional and commercial capital together to increase the scale of efficiency of financing for green and transition projects in Asia. Without further ado, let me welcome Ms. Jillian Tan, Assistant Managing Director of Development and International Group, as well as Chief Sustainability Officer, to deliver her opening remarks. Jillian, please.
Hi everyone, a very warm welcome to the Singapore Pavilion and a good afternoon to you all. I was just telling my team, look around at some of the biggest names in blended finance, all here at our humble little pavilion. We're very, very honored. Thank you very much. Welcome to the FAST-P Showcase. Today, in this showcase, we will feature the Financing Asia's Transition Partnership Blended Finance Platform and learn how managers, as well as capital providers, are reimagining mechanisms to solve bankability issues and spur green and transition financing in Asia. Now, you probably know some of this already, but it's been quite a busy week, so please allow me to do a quick recap of some of the announcements that have gone out this week. FAST-P aims to mobilize $5 billion to de-risk and finance green and transition projects in Asia. Earlier this week, the Singapore government announced that it will pledge up to $500 million as concessional capital to match dollar for dollar concessional capital from other partners. This combined pool of concessional capital will be used to crowd in commercial capital and other sources of finance to accelerate capital flows to support Asia's transition. Now, 3 programs have been announced at COP29. You can see them on the screen. The first is the Energy Transition Acceleration Finance Partnership, or ETAF. This partnership will invest in energy transition projects, including early retirement of coal assets, renewable energy, and grid modernization and development. Our partners on ETAF are ADB and GIAP, and we are in discussions with Clifford Capital to manage ETAF. The second program is the Green Investments Partnership, or GIP. This is supported, as you can see by the many icons on the screen, by the IFC, by the MAS, Temasek, and allied climate partners. HSBC and Temasek will commit capital to support GIP, and the European Commission and Team Europe partners, FMO and DEG, are in discussions to join this partnership as well. This partnership is managed by Pentagreen Capital and will deploy capital to marginally bankable green and sustainable infrastructure in Asia. The third program was announced just a couple of days ago. This is the Industrial Transformation Program, or ITP. IFC, MAS, AIA, MUFG, Nexus, and BlackRock have signed a statement of intent to collaborate on this, and ITP will explore opportunities to provide debt financing to private sector borrowers seeking to decarbonize their businesses. This will include projects in hard-to-abate sectors, technology solutions for the low-carbon transformation, and industrial opportunities. Now, we have a real highlights for everyone today, which is that the managers of these 3 programs will each get 10 minutes to deliver an elevator pitch of their program. I'm not sure which elevator takes 10 minutes, but you get the general idea. So we will have presenting their programs to us this afternoon, Murli Maya, Group CEO of Clifford Capital, followed by Marat Zaparov, CEO of Pentagreen Capital, and then Matt Kazmarek, Managing Director, Head of Emerging Market, Credit Strategy, and Sustainable Investing for Global Infrastructure Partners, which, as you know, is part of BlackRock. So we have Murli, Marat, and then Matt. Because to be a manager in FastP, your name must start with M. After the managers' presentations, I will invite the three of them to a quick rapid-fire Q&A and pose 3 short and sharp questions to them. So stay with us. Let me hand over the time first to Murli. Can we welcome him, please?
Thank you, Gillian. And just for the record, can everyone hear me? Just for the record, my name is actually Murli Maya, so I've got 2 M's in my name, not just 1. Folks, thank you very much. It's an honor to be here today. It's a very noisy background, so if any of you can't hear me, then please do let me know and I'll speak up further. So what is this big mouthful, Energy Transition Acceleration Finance Partnership? What is it really about? It's really about using, as you see on this page, using concessional and commercial capital to hasten energy transition. We have mapped at Clifford Capital, and I'll tell you a little bit about us as I come to the end. We have mapped in our region about 175 separate projects that we believe we could actually look at to be a part of ETAF. Our geographical focus is very much Southeast Asia. It's our near abroad. It's where we live, and we are very focused on it. There may be some areas within South Asia that will also qualify and benefit from the use of ETAF money. Let me just move on to how we thought about creating the structure that we have recommended for ETAF. And really, what we were looking at was a concept of layering. What we were trying to identify was a series of priorities, blend them with considerations, and come up with an actual outcome. So the priorities for ETAF, from our perspective, and you see them on this page here, really to catalyze private capital. We have to mobilize it, and that's important. We wanted to be in a position where we would do a lot of greenfield development for new projects, alongside the managed phase-outs of existing coal-fired plants. We wanted to improve affordability of the green transition itself. And lastly, we need to operate ETAF in as cost-efficient a manner as possible. When you layer that into the considerations from a typical fund, one of the considerations we came on to quite early, and we do this for a living, so we do know, it's harder to put pure greenfield assets, fallow land effectively, into a fund structure if investors are looking for cash yield. So that's one consideration we do have. A second consideration is investors tend to, in a fund construct, want you to deploy money within a fixed time horizon. In a situation where we are trying to break new ground, especially with things like MPO projects, which are complex to put together, we did not want to be constrained with short-time investment horizons. And the third is to try and deliver a set of returns to private capital that mimic an investment-grade risk profile. These 3 things, when you put them together, it led us to one natural outcome, which is rather than going with a traditional fund structure where we have a degree of concessional capital and long-term LPs, we decided at the outset that what we would do was set up a permanent capital vehicle, a balance sheet, effectively. And what does this balance sheet allow us to do? It allows us to accumulate assets with a flexible time horizon. We do it when we find the right assets to put on the balance sheet. The second is we will recycle, and I'll show you that in a little bit more detail. We will recycle assets out of the balance sheet and into our fund structures over a period of time. What this structure allows us to do is, as we migrate from a balance sheet to a fund structure, every limited partner who comes in will have a ready-made, fully banked set of assets that they can diligence understand the risks of, possibly put a rating to. So when the assets transfer into a longer-term home, and as they are all operating, you get a much better sense of what your long-term rate of return is going to be, which we think is really important for investors. I'll show you this in a bit more detail on this page. This is really how, and it's illustrated, but it's how we are looking at it. The first tranche of concessional capital will be combined largely with relatively short tenor bank financing. Because when you do those two things together, you actually reduce the operating costs of ETAF, which we think is important. We will put assets onto this balance sheet. As we fill up the balance sheet to its natural capacity, we will launch our first fund. We will have all of the assets available for diligence by the investors. We will transfer the assets to the fund, and the fund is essentially entirely filled up, or largely entirely filled up, from the get-go. What then happens is our balance sheet becomes empty again. And we go out and we do a new set of transactions. And when we fill it up a second time, we then start a second fund. I'll illustrate that diagrammatically on this page. This is what we hope to pull off. If we execute it well, this is a structure that allows us to create a permanent capital vehicle with a series of successor funds, one after the other after the other. By the time you get to about the third fund, the first fund is largely starting to be redeemed, which then allows you to create a further successor fund and redeploy all of the capital therein. And the intention is, while we are looking at a certain size that we would like ETAF to be, as long as the concessional capital providers are not asking for their money back, you can actually keep going with further and further successor funds. What we find in this particular structure is the strength of a platform strategy. All of this works because it's not based on individual projects, it's actually based on creating a platform where we use concessional capital in the most efficient way possible and catalyze the type of senior capital that can take on the risks that they feel comfortable with, starting with banks and then moving on to LPs. I think I'm well within my time, so Gillian, you should be happy with that. Last and final thing, why do we think we can pull this off? Well, because we've been doing something not entirely dissimilar for the last 12 years. We are a dedicated provider of infrastructure credit based out of Singapore, the brainchild of people at Temasek, the MAS, and the Ministry of Finance. And what we do and what we operate today is a seamless infrastructure credit platform where we originate infrastructure credit now with a lot of companies across the region, largely with the Singapore nexus, but not exclusively. We have a highly nuanced idea of exactly where the market is. So energy, for example, is about 30% of our book. The vast majority of it is renewable. So we are in this market as a practitioner every day. We have a distribution strategy where we actually take on these assets and we securitize them as they become operational, and we distribute them in a product that we created called infrastructure asset-backed securities. We invented the product 6 years ago, and we continue to have about 3/4 of the market share within Asia. So we really know how to structure capital that is able to take a first loss. The first loss that we use is actually entirely commercial. We don't rely on concessional financing, but it is something we know exactly how to structure and manage. And using our existing businesses, both in our client coverage team that deals with corporate borrowers and in our markets team that deals with investors, we believe we have a lot of group learning that will allow us to deploy funds into ETAF through our asset manager in the most efficient way possible so that we create the maximum impact with the money we have. Let me stop there and hand over to the second manager, Marat from Pentagreen. Thank you all.
Need a headset? If you need a headset, please raise your hand and the headsets will hopefully come to you. If you could keep your hands up, please. Because there's lots of good stuff being shared, so you don't want to miss it, yeah? Okay, I'm afraid we're out of headsets, so if anyone doesn't need a headset, please pass it on to the poor soul next to you. All right. With that, perhaps we can now get Marat on stage to tell us about GIP. Marat, please. Let's welcome Marat.
Thank you so much, Gillian. Indeed, it's a competition to be heard in this place, as always. And Gillian, when you mentioned the 3 M's at the beginning, I thought you were going to say the 3 musketeers fighting on the battlefield of climate change or something like this. But let me start. First of all, ladies, gentlemen, partners, friends, great pleasure to be here and a great pleasure to announce some progress, if I get the clicker right, announce some progress on the Green Investments Partnership that we have been working on together with our partners and friends from the MAS and other institutions. Those of you who were present at the last COP28, you will recall the initial announcements that were made around this initiative between the Allied Climate Partners, the IFC, Temasek, and the Monetary Authority of Singapore. We have some new partners that are considering joining this program. Very fortunate to have the likes of Team Europe under the umbrella of the European Commission's Global Gateway Program. The likes of FMO, DEG are considering participation. We're working with the UK DFI, British International Investment, and of course our shareholder HSBC, who is also looking to join this program. So what is the problem statement that we are looking to solve and looking to address? We're talking about sustainable infrastructure, green infrastructure in emerging markets. And for the longest time, certainly since I remember myself starting in this business, we've always talked about the problem of bankability in emerging market infrastructure. The market remains fragmented, very different types of challenges, many small deals, many deals that use some kind of newer technologies, newer business models, which put those deals somewhat outside of the comfort zone of the incumbent and the traditional lenders, traditional credit institutions that are out in the market. You can perhaps conceptualize it as follows. We always talk about these trillion-dollar investment gaps and investment needs in emerging markets infrastructure. And when we look at the market, what we perhaps discover and come to the conclusion is that only 5 to 10% of the project universe that's out there is very clearly bankable. You show up in a bank, you show up in an HSBC, you show up in a DFI, and you will get a loan. You will get a loan to fund that project. At the same time, on the other end of the spectrum, there's probably half that are clearly unbankable, either fundamentally flawed or perhaps should be the domain of the public sector to finance. And there is always this gray area in the middle, right? What we call the marginally bankable. All these deals and all these assets that when you're a banker, and I used to be one, they come across your desk and you think, this is very interesting, I'd love to do something here, but you know what? This will never pass my credit appetite of my regulated institution. And it's this marginally bankable space where we see a lot of deal flow, a lot of projects, they're all hard work, but they require a very specific balance sheet in order to be able to fund repeatedly again and again. So the partners working together on this vehicle believe that blended finance is part of the solution, or at least it's the way to shine a light on the path forward, to fund more of these marginally bankable projects, marginally bankable situations, starting in Asia, of course, for us, but over time, and this need not be our business going forward, this can be replicated, or a model that can be replicated for other marginally bankable problems and perhaps also other regions. This particular partnership will target sectors and geographies that are presented here. You will notice that the sectors are largely in the areas where the technologies are somewhat more mature and somewhat established. You see, it's quite interesting that in Southeast Asia, we're actually really underinvesting in our climate infrastructure, even across the established technologies. I'll give you some data points because no banker presentation is complete without some data. Southeast Asia contributes 6% to global GDP. So our region is 6% of the global GDP, 5% of global energy demand, and 9% of the world's population. And yet, when it comes to clean energy spending, Southeast Asia only accounts for 2% of global clean energy spending. So we're massively underinvesting, even in the so-called more mature, more established technologies like wind and solar and battery storage, etc., etc. We also have a geographical country base which by now has moved out in large part of this low-income universe and into the so-called middle income, and yet we're still underinvesting. And within this landscape, we are focusing on a number of priority themes that will deliver maximum additionality, impact, replicability, and ultimately, through all of these themes, as deals get done with a blended capital stack and with concessional capital in the mix, over time, these are the business models and these are the themes that can stand on their own 2 feet and become viable as a purely commercial financing proposition. Real-life activities have validated this thesis. We're doing deals already. Some of them are presented on the slide. And a lot of these deals will also form part of the new partnership activities that GIP will undertake. And maybe finally, what is the Green Investments Partnership and what is the opportunity that it presents? And what is the problem statement that it's trying to solve? $1 trillion plus opportunity set remains fragmented and difficult to finance and results in a lot of underinvestment, even in the traditional clean infrastructure that we see in Asia. As a result, there is a significant volume of high-impact, replicable green infrastructure projects that remain stranded and are unable to raise financing from traditional sources. And GIP is the kind of construct that is able to pull all of this together and pull the right partnerships together to make it happen. Of course, nothing happens in this world without collective efforts amongst world-class partners with different skills, different resources, even different perspectives. There is difference, but fundamentally, we share the same values and the same vision. And that vision is to bring more infrastructure, more green infrastructure into implementation in emerging Asia. Thank you very much.
Thank you, Murat. Well said. Well said. And last but certainly not least, we have Matt to come and tell us about ITP. Let's welcome Matt.
Hello, everyone. My name is Matt Kaczmarek with BlackRock, and it's a pleasure to be with you here today. And thank you so much to our partners with the Government of Singapore and the Monetary Authority of Singapore for giving us the great honor of being a partner on this FAST-P initiative, this really groundbreaking initiative. BlackRock, our goal here is simple. We want to mobilize capital to accelerate Southeast Asia's industrial decarbonization, and to do this in one of the most exciting regions in the world. Now, BlackRock is obviously a global firm. We are a large asset manager. We have operations around the world, and we invest around the world. But Southeast Asia is one of the most exciting regions that we see the potential to do this work in. For example, the countries of Southeast Asia experience rapid economic growth. Companies, the partners that we finance, have a strong desire to grow in a sustainable way and advance their own decarbonization objectives. And these are dynamic markets with strong demand for private investment. So we see a really strong investment opportunity here in this region. Now, we know the historical impediments to attracting institutional capital. And we intend to address each of these. I'm going to focus on the ones down here at the bottom. Our strategy is designed in order to address each of these issues. For example, high sovereign risk for foreign investors. We'll get to how we're going to use the blended finance strategy in order to help reallocate and efficiently allocate that risk. Shallow capital markets. By building a partnership that involves all the key players in these markets and in the finance chain, we can bring together all of the players necessary in order to deepen capital markets and help facilitate greater domestic investment for development as well. Lack of sufficiently prepared or bankable projects. You heard a lot about that in the last presentation. We are also focused on that here with our corporate investment targets as well. So the Industrial Transformation Partnership is going to give institutional investors, the kinds of folks that we are used to working with every day and have strong partnerships with the leading institutional investors around the world, the opportunity to invest in both Southeast Asia's economic growth and development, as well as advance their own portfolio decarbonization objectives. We're going to deliver climate change mitigation results and also adaptation results as well. And we're going to do that in 3 key areas. The first is is low carbon industrial transformation, where companies are looking to take the steps that they need to take today using technologies that are available today in order to finance projects that will help them reduce their emissions footprint. The second is we're going to take a sector approach to working with companies that want to be leaders in hard-to-abate sectors to help drive capital, to help them develop a competitive advantage by taking the steps that they need to take and coming up with new ways of addressing the market leaders in these sectors. And the third is using emerging decarbonization technologies. Now you see a bit of a evolution here. There are, the first pillar is the easiest one to do today using technologies that are available today. The second is going to take time and thought and the cooperation of all actors involved. And then the third, emerging decarbonization technologies. There's a lot of climate solutions out there. It will take time for those solutions to be available at commercial scale in these regions. And so what we see for ourselves is a pathway to deploy immediately and a pathway to long-term deployment over the horizon as well. And BlackRock's going to do this with both out of our strong presence in Southeast Asia today, based out of Singapore, as well as our international partnerships with investors around the world, along with regional sponsors in the region and the companies who are seeking the financing for the projects they want to pursue. And all of that together will help the countries of Southeast Asia contribute to their national emissions reduction commitments. We're going to use a blended finance approach to do this. And as we've talked about, the role of blended finance, the excitement about blended finance is that we can use a limited amount of scarce public resources to catalyze and mobilize a significant amount of private capital into this region. So we're going to, in partnership with our catalytic capital providers, including the Monetary Authority of Singapore, we're going to build a strategy that is designed to disaggregate the risk that investors experience when they invest in these markets today. Our investors are comfortable. Infrastructure debt has grown as a global asset class over the last couple of decades, and investors are very comfortable holding private infrastructure debt on their asset allocation. They're comfortable with the risk, and they're comfortable with the sectors that we invest in. The real challenge for us to tackle is the market-related risk that exists. So by using concessional finance to reduce the risk level to a level that investors are comfortable experiencing and know what they're experiencing in other markets, we can all of a sudden make these investments and make this capital allocation much more attractive to a wider range of investors. And that's our objective here. One, to use the capital, the catalytic capital in just the right way with just enough. Second, to reduce the risk level of the portfolio of assets to something that is comparable to what investors might see in developed markets. And third, to use that to build a scalable investment strategy that will create a market over time. And we are extremely excited to be launching this in the Southeast Asia region and through BlackRock. BlackRock is a leading market participant in the Southeast Asia region. We have over 700 employees in Singapore. We consider ourselves to be a local company in Singapore. We helped to found, for example, the Singapore Sustainable Financial Association, and we are active in the financial community in Singapore. And we really believe that here we have an opportunity not only to manage this strategy out of Singapore, but to bring together all of the key players in order to make this a success. Tuesday, we announced the partnership, and we launched it with the Monetary Authority of Singapore, MUFG, and NEXI, the Japanese government entity, the IFC, and AIA. So we're really excited about the founding partnership that we established here. And we look forward to bringing the strength of our excellent global relationships, our deep presence in, and our knowledge of the Southeast Asia market, and bring this partnership to fruition over the next year. Thank you.
Thank you very much, Matt, and our three speakers, Muli, Merat, and also Matt. Let's give us them a warm round of applause, and also for the detailed sharing on the three programs under FAST-P. Let me now invite Gillian, and also the three asset managers on stage to engage in a rapid-fire Q&A sessions.
No worries. Hi there. Thanks very much, Suyun. So we've done so well on time because these gentlemen are terrified of me. That we might actually have some extra time for questions from the floor, when I'm done with my rapid fire questions. So I let you know that now so that you stick around and prepare your questions. Don't give them an easy time, all right? Okay, come, gentlemen, join me here, please. The three musketeers, ladies and gentlemen. Let's welcome them, yeah. All right, so let's get started. So, I've been working on this for a couple of years now, and what I've realized is that the holy grail of blended finance is platforms that have minimal concessionality and maximum additionality. I'm sure I don't need to explain that to anyone in the audience, but in brief, we want as much financing for projects that would not otherwise have received the financing, but to use as little concessional capital as we possibly can. So you each have 3 minutes. Tell us how your strategy seeks to achieve that holy grail. And I'll start with you, Molly.
Thank you. I always appreciate being the first person to ask the question. Look, folks, I think for us, there are a few elements. Wow, it really is rather noisy. So please, again, tell me if you can't hear me. There are a few different elements in what we're trying to do. The first thing is, because we are in this market, we do about 70 closed transactions a year. That's the normal volume. And about a third of those are in energy, and 100% of what we do now is renewables. And therefore, when we look at the market, and this is across Asia Pacific, we are actually able to tell which transactions stand up to commercial scrutiny. In fact, the reason we were set up is to find gaps in the financing market and try and plug them, particularly around tenor. So we've developed this as a natural reflex for the organization. There are definitely transactions in the renewable space, we're not guessing, we know where they are, where the application of a very small amount of concessional financing to make one technical aspect work and provide the right type of risk return for the people who sponsor it, those transactions absolutely exist. Sometimes they're sectoral, so offshore wind in some cases. Sometimes they're geographical, depending on which country you actually end up going to and how investors look at the risks in those countries. But they are absolutely available. And we tend to deal largely in bankable transactions on the renewable space. Those are really double B type countries, sometimes triple B. So that's one concept. The second is the managed phase outs of carbon intense assets. This is a critical reason why we were created. There isn't a natural template in the market for how those transactions are going to get executed. There are a couple of really good examples, but there's a lot more that needs to get done. And I think as we start to apply some of the ETAF blended finance principles, we're going to need to find and create over time a natural template that can be replicated. So that's the second big strategy. The third one on the grid modernization and resiliency, there is a long-term, for those of you familiar with Southeast Asia, you will know that the ASEAN power grid is a long-term strategic ambition for the region. It's proven very hard to execute. In the delivery of renewable energy across the region, we think there will be real opportunities, very specific to begin with, and probably over a couple of decades will get us to the right outcome. So those are the three strategies.
Thanks very much, Mani. So basically, in certain areas where I guess Clifford Capital has extensive experience, you know it already, you feel it, you've lived through it. But in coal phase out, which I think we can all agree is a very challenging area, we're going to have to do that journey and get to that answer. Yeah, fair.
And we're also deeply conscious of the fact in our part of the world, there are lots of new coal capacities coming up. And we need to try and find ways to forestall them.
No, absolutely. No, thank you for that. Marat, over to you.
Yeah, so minimum concessionality and maximum additionality. That's to us, these are really two sides of the same coin in many ways. On minimum concessionality, part of it is very simple and part of it is more complicated because it requires taking a view. The simpler part is this. The way that the partnership is designing its capital stack is to, number one, maximize the commercial elements within the capital structure, and therefore minimize the concessionality that's required to bring that commercial element in, right? That's really a design feature, a core design feature of the capital stack. And really, in this way, it's the minimum concessional piece that's required to kickstart the program. The other side of the coin, the additionality piece, the themes and the strategies that this particular vehicle will focus on are the deals that, number one, find it difficult to raise pure commercial capital today. It's not the bankable space, it's the marginally bankable space. It's termed that for a reason. But these are also deals and projects that are not supposed to be one-off just because they're projects that struggle to raise money. It doesn't mean we should all go ahead and fund them. These are projects that are representative of a theme and of a trend. And these are projects and deals that over time, with track record, have the potential to stand on their own 2 feet. And we want to see these transactions being funded by pure commercial capital in the future. In this way, sometimes we joke, we're somewhat working ourselves out of a job, because in a few years' time, the kinds of deals that we get used to funding and got good at actually will be funded by the more traditional lenders out there. So 2 sides of the same coin, Gillian.
Thanks, Marat. Don't worry. I'm sure by then we'll find a new challenge to work on together. So what I'm hearing from you is that underneath that broad label of marginally bankable, when you unpack it, you actually get to that holy grail, and that's the goal. Okay, Matt, last but not least, the holy grail. Are we trying to do too much? Do you think it's achievable?
It's definitely achievable. We are focused on a set of investors who are currently not present in the region in these types of assets, and we are focused on a type of capital that borrowers are unable to access today. So first of all, we have a very clear focus on the type of capital that we're trying to invest and the type of lending that we plan to do. Beyond that, GIP, Global Infrastructure Partners, not the other GIP, a part of BlackRock, has 30 years of experience structuring funds and working with investors to provide capital to invest in both developed and emerging markets. And so we understand exactly what risk-return profile our investors are looking for in order to invest in developed markets, and we can apply that same framework to how to structure a fund in emerging markets and understand exactly what level of risk buy-down needs to occur, how to do that in a convincing way that builds credibility with our investors, and exactly how much concessional capital we'll need in order to build a model portfolio that investors feel confident investing with us in. So we have 3 goals here. Number 1 is we're going to demonstrate investability in the industrial transformation asset class. Number 2, we're going to use limited concessional resources from the start. So our high watermark is in the first instance of this partnership. And then we want to structure this in a way that allows us to reduce the amount of concessional capital that we rely on over time so that the initiatives and the partnerships live on, but we can put the concessional capital to work in other challenges.
That's so incredibly powerful. I think many of us worry about that emerging market risk premium that we're all concerned about. So if you can crack this, we're very keen. All right, let's move on to the second question. One thing which I'm sure the eager beavers in the audience have spotted is the fact that all 3 programs seem to have energy transition and renewables. What specific aspects of energy and renewables are you each looking at? I'll start with you, Matt, 2 minutes.
All right. We're looking at 3 things. 1, our strategy has a corporate focus. So working with companies on joint ventures, special purpose vehicles, we're going to enable companies through our strategy to move ahead and not be limited by the constraints that they might face in their sector, in their market, or frankly, by their own public sector. And we're going to work with companies that want to gain that competitive advantage, that have decided on the path for decarbonization for them, and facilitate that. We are focused on hard-to-abate sectors. So we want to focus on the companies that are going to have the highest mitigation impact, and we're going to deliver that outsized emissions reduction benefit to our investors. And then third, we're focused on transformational emerging technologies. So as those technologies gain applicability and commercial scale in developed markets, we can bring them and apply them in the emerging world as well.
Great. Marat, how about you? I hope it's different.
We think it's very different. I hope you agree. So our strategy is very much focused on greenfield. So that's a key feature. Greenfield, new infrastructure, new builds, new projects, shovels in the ground, bricks and mortar, new construction. So that's number 1. We are very much focused, again, I keep going back to this term, the marginally bankable. These are the more difficult projects, the more difficult deals that are out there that cannot be done with more mature, more mainstream strategies. And in fact, the capital stack, the way it's designed, it keeps us firmly within that lane, just because of the way the risk reward works. And our strategy is very much, and there's a bit of an industry term, developer driven. So developers that actually go out there, get the permits, get the land, and actually look to start construction of these assets, these climate infrastructure assets. So it's quite a different approach to what our friends in BlackRock are doing.
Yeah, no, definitely quite different. And how about you, Murli?
So renewables is anyway a core sector for us, and we spend a lot of time in that space. What I will say is we are used to, and the way we are set up and the way we analyze risk is very much around bankability. The one concern that I continue to have is, or maybe it's more than one concern, it is scalability. How quickly can you deploy very large amounts of capital to build much larger renewable projects? So really, are you being constrained by the last available dollar of commercial capital, and therefore your ambitions are concurrently constrained as well? And that's something where we need to work with particularly our corporate clients and get them to have a bigger ambition up front. Because if you don't have this sort of time to market as a key component of what you think about when you can set up renewable capacity, how fast you can build it, we know how to do this for the clients that are commercially feasible today. We need to be able to extend that expertise so that not only do we bring these renewables to market, we are able to scale them up and get them out faster.
There's actually some commonality between what BlackRock is looking at and what you just said, because I think the ITP approach is very much corporate-driven activity and making sure that those moves can be financed. And you're making that broader, important point that actually that there's a process that goes into that as well, and getting folks to understand what they can achieve. Okay, so that's great. All right, so pass. I think there's clearly quite separate stuff. And of course, Murli, you're the only brave soul touching coal phase out. So I think we should give Murli a clap for that. Yeah, well done. Yeah.
Thank you. We'd also like some money.
Yeah. All right, last question from me. The three programs are obviously at quite different stages of development. ETAF and GIP, this GIP, they were announced in COP28, and ITP, I think, has taken shape more recently over the course of the last year or so. In 2 minutes, can you tell us what is one key challenge that you've encountered already? I'll start with you, Murat, just for fun.
One key challenge, only one? That's a shame that I only get one. But look, there are many, of course, and hey, what's life without some challenges, right? But I think one of the main questions and issues that we keep grappling with, and this is an iterative process, is, to convince the partners to take that leap into the unknown, right? And maybe it's because we're pushing the boundaries a bit too far on too many fronts. Greenfield, EM, marginally bankable, not even bankable. That's discomforting to many partners, right? And we're all trying to achieve the same outcome, but we're coming at it from different directions. If I'm the concessional capital provider, if I'm a philanthropy or a government, I want maximum frontier stuff, maximum impact. If I am the commercial capital provider, you know what? I want to fit it into my existing box. I want as much de-risking as possible. I want it to look like a product that I understand and reduce that risk. And so resolving these tensions and these differences in a very constructive way without defaulting to just the box that one party needs or the other party needs, and without making something that's just lowest common denominator, but is actually constructive and can be flexible and can really practically address the issue, that is not a trivial challenge. That's something to work through.
No, I intentionally gave Marat only one challenge because we don't want to turn this into the psychiatrist counseling chair. And actually, working with Marat and with the other managers on trying to put FASTP together over the course of this last year, it's become obvious to me why polygamy is outlawed in most jurisdictions. It's really difficult having more than one wife, right? And you're dealing with many different partners that come with very different mandates, very different expertise and experience, and everybody wants their way. So, I think Deputy Managing Director Sing Chong said it really well this morning when he said we need to step beyond our mandates and really work for the greater whole. And it's getting that, and I hope FASTP can achieve that. Okay, Matt, I'll give you the next one. One key challenge, just one.
So we're a little earlier stage in our development, but I'm going to pick up on exactly what Jillian said, which is for us, I think, and this is true across climate finance, every investor has a particular strategy, a particular country set, a particular sector they would like to involve in, a risk profile they would like to achieve, and an investment outcome. Importantly, the sustainability outcomes that investors are looking for, whether it's mitigation benefits, adaptation benefits, what they're looking to produce, are all different. So the challenge that we face in building a sustainable and a scalable blended finance platform is to bring all those together in a way that brings all our partners to the table. I think the three strategies here have all done that because we're not doing this alone and we're not doing it by ourselves in partnership with MAS. We're doing it with a whole consortium of partners, and it's really exciting to see that. And I think that the leadership that the government of Singapore has shown by having a strong voice and using that voice and putting actual capital on the table, along with the leadership of the partners here, is helping to provide that table for others to come to. And it's pretty powerful already.
Thanks very much, Matt. No, absolutely. And I think we will need to share our learnings from this journey with the broader community so that, we can actually do better in future transactions, in future structures. Murli, over to you. One key challenge.
So in the transactions that we will look to take on, where we apply the minimum level of concessional capital, I guess the biggest concern that certainly I have is just time to market. Because it's, and I think Matt spoke about, and Marat spoke about how do you get investors to the right place to accept risk-adjusted returns in our part of the world. But time to market and execution is actually everything. If we're all standing on the same burning bridge, we need to get a move on. And dealing with that while you're simultaneously trying to raise a significant amount of capital, get people convinced that on a risk-adjusted basis the return makes sense, and mobilize private money, while at the same time you're trying to deploy as quickly as you possibly can, it's a very difficult and tricky balancing act. But I suspect that's the reason why the three of us have been given the mandate, and we'll do the very best we can.
Thanks, Murli. I mean, we hope also that as we learn more, the next time will be even faster, but that's what we need to aim for, I think. Okay, so now's the moment. Wow, okay, many questions. I think these two gentlemen were first. Well, the mics will come round. Can you please introduce yourself and say where you're from?
David. Yeah, okay. I'm David Lehrer. I'm from the Aravai Institute for Environmental Studies in Israel. For many private sector actors, the biggest challenge is not the private sector, but it's the public access to, especially when it comes to energy, the electric grid, and the fact that in many cases, especially in emerging economies, the electric grid is not accessible or appropriate, especially for renewables. So two questions. One is, do any of you try and work on that aspect? Is that not one of the biggest challenges, is finding financing to upgrade emerging economies' electric grids? And the second thing, what do you think about decentralized technologies? Do they have a role in this sphere?
Thank you. So public policies, I guess, and decentralized technologies. Who wants to go?
I'll start. Absolutely. I would say as we work with partners across the region, we're going to be looking at companies that are limited and constrained by what is available in the market they're working in, looking to execute their own decarbonization strategies. In some cases, that may involve withdrawing from the grid, financing their own sources of renewable power, contributing back to the grid, and grid strengthening in some cases. So we really see that as an advantage that we're looking to pursue here.
Yeah, perhaps on the decentralized part, clearly that's a theme. It was one of the themes in the presentation that I showed, although we call it distributed energy rather than decentralized. And that's really, in emerging Asia, a feature of the market. This is towards the area that business models are moving. away from a large centralized asset selling to one customer into multiple smaller assets selling to multiple customers. And these are business models that are a bit new in the emerging markets context and not so well tested, so are certainly marginally bankable. Of course, battery storage comes into play and helps to solve some of the grid issues. But perhaps on the grid aspect, our colleagues at Clifford Capital, Merle is best placed to talk about.
Sure. In our part of the world, so Asia Pacific, it really is only 2 countries that seem to have spent time, energy, and money to deal with the fact that they're going to have a lot of renewables: India and Australia. Now we have certain topographical challenges in our part of the world. If you think about the European continent, you have a few hundred islands. Southeast Asia has 26,000, and many of them are occupied by people. So it isn't even about can you deliver renewable energy through grid expansion, it's can you deliver electricity, period. And it requires an enormous amount of undersea infrastructure. It involves an amount of distributed infrastructure in many ways. It's an ongoing challenge. It's not a small challenge. But are there particular projects between off-take point to off-take point, things that address specific geographical constraints that we can get involved in? Yes. But this is not a short solution.
Yeah, thank you. Sorry, who has the mic next? Yes, please go.
Yes, Sébastien Richer. I'm from a small local association called JISOC, which promotes low carbon energy. But my question has nothing to do with low carbon energy. My question has something to do with financing. You are representing 3 modes of financing, basically. How do you contribute together to the financing of the projects? Do you see your work working together, or you are working separately on different subjects?
Maybe I can take that one, and then we can move the microphone over to that side of the house where there are a few questions there. I mean, just to say that all 3 programs come under the FAST-P, and the vision there is really using blended finance in the most additional way to unlock capital for transition financing in the region. We have as you've seen, 3 quite different programs with different focus areas. Frankly, some of the structures will also be quite different. And I think what we're trying to do is give some options, see what works best, and then make adjustments from there. So they absolutely will work together. There will be sort of FAST-P oversight and the FAST-P spirit that permeates all 3 programs. But they're also quite different, and they're using their own view, their own investment thesis on what works, and that's by design. Because frankly, I think there are many modalities that could work, and I think we're still a ways off to figuring out what will work. Next question, please.
Hi. Can you hear me? Oh, okay. Hi, my name is Collins. I'm from Lex Consulting, from Nigeria. We do advisories for, government and helping them attract climate finance and funding for renewable energies and, grid projects. So my question is to 3 of you. Amid decreasing aid and rising debt, securing financing for Africa transition is a challenge, right? So while some sectors attract climate finance, others lack funding. And when you come to Africa, the whole climate financing is just 5%. So what are you guys doing to make sure that Africa is one of the big market where these funds go to, and because it's a big market, right? And there's an opportunity. We are marginalized, if I would say that, because we when it comes to this climate change thing, Africa, the emerging markets, the developing countries suffer more, while they are not the one, destroying the world, right? So what are you guys doing to make sure that Africa attracts these funds and, you're helping Africa? Because I haven't heard anything from this.
Thank you, Colin. Thanks very much. No, I'll let the managers come in if they want, but, our focus for now is Asia, because, like Africa, Asia is another area where some of this financing has been quite limited, and this is attempting to address that. But managers, I think some of the lessons we are going to pick up will be of general application, including to other challenging regions. I don't know if you want to pick up maybe one or two of those, and then we do need to wrap up. Murli, go ahead.
I'm happy to answer. So Gillian's entirely right. The FASP initiative is focused on Southeast Asia, with possibly an extension into South Asia as opposed to Africa. Our remit as an organization is with a majority of our clientele have a nexus to Singapore. And I think one thing Singapore companies do very, very well is invest globally. Wherever they go, we will follow. And as the economic opportunities become more prevalent within Africa, I think some of the financing technology that we have, some of the learnings we have, I can certainly hope that that's extended. Is it something we can promise? Obviously not. And it's very much dependent on the activity of our underlying corporate client.
Thank you. And that's the MAS's commitment to everyone here, which is that we want to share the lessons that we learn so that others can benefit from that as well. We've run out of time, I'm afraid, but I want to thank Murli, Marat, and Matt for painting such a vivid picture of your strategies in such a short period of time. We appreciate your candor, especially on the challenges that you're facing. And we're going to hand over the time to the next segment for them to solve these challenges. Right? Cindy, you got that? Yeah. Everyone, can you please join me in thanking our three managers this afternoon? Thank you very much.
Our speakers. Thank you, Gillian, our speakers. Can I ask that you remain on stage for photos? I would also like to invite Sing Cheong, Deputy Managing Director of the MAS, and Connie, Head of Financial Service from Temasek, to join the speakers on stage for the photo. That's Connie. Yes. We also noticed that there are FAST-P partners in the audience, so may we also invite them on stage for the photo opportunity as well, please. Yeah, we also noticed there are FAST-P partners in the audience. May we all invite them on stage for the photo opportunity as well. Anyone else? Anyone else? Anyone else? Come on, Dante.
Sorry.
What is this person going into the... That guy is a partner? Why is he in this? Should I ask him? All these FAST-P partners, other than... Thank you. Thank you very much, everyone. We've just heard about the vision and catalytic impact which FAST-P will bring to support transition in Asia. But blended finance is not without its challenges, and the key is how we can maximize additionality with minimal concessionality. This brings us to the next segment. Oh my god, oh my god. Can we have them off the stage? Thank you, everyone. There's a next segment going on, so may I ask you to clear the stage as well? Can you help me to clear them out? Thank you.
How do you want to do this?
Yeah, so I would. Test, test. Should I start now? Okay, let me know when to start. Yeah. Okay. Test, test. Okay, should I ask them to take a seat first? Oh. Thank you, everyone. The next segment will be starting shortly. Could I invite you to take a seat at the foyer, please? Oh, sorry. Okay.
Okay, so Keith is ready. We
Yeah.
just need to introduce him.
Okay, I start now?
What's
I will just start from
unveiling,
here.
right?
Okay, I just start. We start the whole thing. Thank you, everyone. The next segment will be starting shortly, so can I invite you to take your seat in the audience, please? Thank you. We have just heard about the vision and catalytic impact of FAST-P will bring to transition in Asia, but blended finance is not without its challenges, and the key is how we can maximize additionality with minimum concessionality. This brings us to the next segment, which will uncover how commercial and also concessional capital providers can redesign finance mechanisms to mitigate bankability and also spur sustainable finance, infrastructure financing. May I now invite Keith, Director of Sustainability and Public Affairs from Temasek, to give an opening, please.
Thanks, Soon. Can everybody hear me? Okay, I know we're all excited to talk about the how and the what of blended finance, but just a quick introduction for those of you who may not be aware or acquainted with Temasek, which I'm sure you heard a lot of in the discussions around FAST-P and our collaboration with the Monetary Authority of Singapore. So Temasek is a Singapore incorporated investment company. We were founded in 1974. We are owned by the Singapore government, but our investment and commercial operations are not directed by the Singapore government, so that's a very important distinction. Our net portfolio value as of 31st of March this year was just south of 300 billion US dollars. important distinction as well. We own and manage our own balance sheet, we invest off our own balance sheet. We own and manage our own assets. So we are an active owner and investor. A lot of the companies in Singapore, across the real economy, are part of our portfolio. So if you think about the likes of SIA, Semcor, and many others that you might be familiar as Singapore brands. And we have about 1,000 staff across 13 offices in 9 countries. Our purpose, and this is why it's so tied to sustainability and climate, is so every generation prospers. And we, because of our long-term mandate, really believe we have a role, and it's well aligned with our investment mandate to ensure long-term resilience and sustainable returns. I just wanted to run through very quickly that we have our portfolio value invested in sustainable living trends. So these are assets and investments that are aligned with some of the 7 focus areas that you see on the slide, was $44 billion. And we actually disclosed this in our inaugural sustainability report that was launched earlier this year. Broadly categorized into 2 types of investments, so sustainability-focused investments, and these are investments that speak to each of the 7 focus areas, as you see, as well as a separate category called climate transition investments, and these are companies which we invest, which may be currently in hard-to-abate sectors, but they have shown a clear commitment to transition their goods, products, and services towards sustainability, right? So that's some of the examples you can see there. We have a 3-pronged decarbonization strategy. We talked earlier about how we invest in a low-carbon economy. We also encourage decarbonization efforts across our portfolio companies and enable carbon market solutions. You may also be aware of our platform, carbon solutions platform, Gen Zero, which obviously featured prominently in the first 2 days of the Singapore Pavilion. Our net zero ambition remains clear. We aim and we have ambition for net zero by 2050, and we are on the right trajectory to halve our net carbon emissions by 2030 based on 2010 baseline levels. We have our own notional internal carbon price of $65 US, and this is a price that we factor into the cost of investment, and we aim to increase this to $100 by 2025. Alongside this notion of investment, we also understand that sustainability requires systems-level change, and that's why we collaborate with many of you, like-minded partners, to catalyze this systems-level change and to form strategic partnerships to drive and to build capabilities and deploy capital, both across different growth stages. And this would include, for example, our partnership, as you can see, with Breakthrough Energy and Enterprise Singapore, to establish the first Breakthrough Energy Fellows Hub. And that's the first such program outside the US to bridge the capabilities gap in climate tech innovation in Southeast Asia. But of course, we are all familiar with what we've been doing, and as the panelists articulated earlier, in terms of our efforts to catalyze blended finance through FAST-P and Traction, which is the transition credits initiative. We also do convening. So we have a flagship program, flagship conference in Singapore called Ecosperity. Some of you will be familiar with that, and it's our 10th year of running the program. I think we're very proud to say that it's grown and evolved and involved many of you alongside to enact the systems level change that we need across multiple sectors and areas. And we really look forward to be able to drive even more sort of catalytic efforts in the next 10 years. So just a quick milestone this year was our 10th year anniversary. We had about 3,000 participants, over 20 partners coming together from diverse sectors to discuss ways and means to translate commitments into action. And this is just a quick plug for next year. We will be doing Ecosperity Week 2025. And our theme, as you see, is Asia's Race Towards 2030. We think that's important to look at sort of immediate milestones, and with 2030 just 5 years away, how do we sort of think about the solutions, the policy levers, and the commitments that are needed for us to be able to meet the hopefully the 45% reduction in emissions by 2030 and be able to bring and not overshoot the 1.5 degree mark. So really look forward to those of you who will be in Singapore during that time to join us next year, May 5th to 8th for that. But for today, without further ado, I wanted to introduce the next panel, and we have titled this segment, Maximizing the Multiplier on Catalytic Capital. I would like to invite Cindy Levy, Senior Partner in the London office in McKinsey & Company, to join us as our moderator. Cindy, please.
Excellent. Can you all hear me? Yep. Thank you, Keith. Jillian said we're going to have all the answers to all the questions that were asked on the last panel, and we might because we have exceptional panelists. And I will introduce them in just a minute. But what is today's panel about? So we know that to really get capital to flow into emerging markets and developing economies, it takes full capital stacks. It takes coalitions of senior equity, junior equity, different forms of debt financing. And it is often stated that catalytic capital is the key to making these coalitions work and really maximizing additionality, as the last panelist commented on. So today we are going to talk about that. Catalytic capital, what stands in the way of bringing it to the table, what is actually working now, what are some of the structures that are gaining traction, and what are some of the structural changes that we need to really weigh into in the years ahead. So these panelists are both very innovative. I saw many of them speak earlier this week, and they're also very pragmatic. So I think we're going to have a great discussion. So I will start my introductions. Connie Chan of Temasek. Please come on. Maybe take the second seat. And Connie is the head of financial services at Temasek. She is also responsible for Temasek's sustainable finance initiatives, which include Pentagreen, but also Temasek's participation in FAST-P. So welcome, Connie. And I will invite Mason Wallach from Climb Capital. Mason is the CEO of Climb Capital. He has over 20 years of experience of energy investment primarily in Southeast Asia, and has personally supported over 70 billion in successful transactions. And I will call on Vinny. Vinny, please welcome. Director General of ADB's Southeast Asia Department. Vinny's based in Manila, and he leads planning and delivery of ADB's goals in Southeast Asia. And last but not least, Elizabeth Yee, Rockefeller Foundation. Please join us. Elizabeth is the Executive Vice President of Programs. She oversees the Foundation's portfolio of global programs and has been with the Foundation since 2019. And before that was very involved in resilient cities. So welcome to our panelists. I will move over here. Excellent. I hope everyone can still hear. To get us going, I want to ground us in some of the realities of concessional capital, because it's very easy to say all we need is more concessional capital. If only the concessional capital providers, the catalytic capital providers would step up. But let's start with the realities, and let's start with some of the challenges of what prevents concessional capital from flowing at even greater pace. And I'm going to go Connie, Elizabeth, and Vinny in that order to get us going. So Connie.
Sure, thank you, Cindy. Can everyone hear me? Yeah, so I think in the last discussion as well, this was mentioned a lot in terms of kind of historically how blended finance was put usually by project basis. And it's very hard to scale and repeat and the velocity of that through a project by project basis, especially in the emerging markets where you see a lot of fragmentation, more bespoke projects. And so really need to bring it up to a kind of system level, right, as a entity level or fund level to try to tackle that. I think the maybe the second issue is, the lack of kind of anchoring leader in trying to corral parties to come together to bring that concessional capital. And what's very encouraging and impactful about FAST-P is, Singapore government is taking that leadership role to basically catalyze other concessional capital to come in, and that will in turn mobilize a lot of commercial capital as well. And I would just say lastly, the more precedents, the more examples we have of successful case studies, I think, and more data that's kind of pointing to the impact of this concessional capital, that will just encourage more concessional capital to come in into the region.
Okay, amazing point. So we've heard about concessional capital often being more deal level rather than vehicle level. We've heard about the difficulty of finding partners, amalgamating partners together, and then also really case references on what works. Elizabeth, let me go to you.
Sure. You can hear me? It's so interesting to have this sort of silent disco thing going on. First of all, I just want to congratulate Singapore and Temasek. The leadership that the government, can you
maybe a little closer?
A little closer. Okay. The leadership that the government has shown is really, really amazing and driving innovation, in particular in Asia and around the world. I just wanted to offer 3 thoughts, and I was just sketching down my notes. So if you actually look at philanthropy, there's about 260,000 foundations in the world that pay out about $150 billion a year. That is a good amount of money, certainly, but nowhere near the trillions of dollars that we need to be able to close the finance gap. And so I think philanthropy can play a really important role in being catalytic, but we need other sources of finance. And what I've asked our institution to do and others to do is, our history is grant making, and certainly that is something we can do to try to get good ideas off the table. The other thing that we need to do is actually use our capital differently. We need to use it as first loss guarantees. We need to use it as junior equity with the goal of trying to drive greater private sector investment into these spaces to make these opportunities much more durable. And I think that what we can do with our philanthropic capital in these spaces is make sure that we actually take the risk off the table, start developing the track records that need to help, that need to exist, and really start building the opportunities in the space that demonstrate what the role of blended finance is. Climate is where we should be investing. It is one of the best investment cases long-term out there. And I think what we want to see at the end of the day is governments, and in particular the private sector, moving with more intention and speed into the space.
Excellent, Elizabeth. Vinny, I'm going to turn to you to start
Sure.
to bring in the MDB perspective.
Sure, thank you. And also, I want to congratulate the Singaporean government on the launch of FAST-P, which is super important given the huge financing gap and the need for blended finance in the region. Maybe starting from the 2.4 trillion that Lord Stern noted in his new report. Huge financing gap. What do we need to do from an MDB perspective? And maybe I take a step back and talk a little bit about the infrastructure, enabling environment. There is the policy, the regulatory risk in many of our countries in the region that can and need to be addressed, and through policy dialogue, through reform support, etc. There is the hard infrastructure. There is no energy transition, no transition without transmission, right? The solar power plants, they do need the transmission lines and the access roads, etc. But also one thing which came up in a number of discussions in the last few days are the people. Where are the people? The people that are needed for the skilled people that are needed for infrastructure projects, for example, that are needed to undertake those reforms. They need to be skilled and trained, right? So these are large challenges. The second point I want to touch on came up in the previous session, that of bankable projects. And that, of course, it's true for private sector projects, but also for public sector projects, maybe even more so. And there are some new approaches which, for example, the Philippine government, the Indonesian government, they are setting up project preparation facilities. The Philippine government, for example, is borrowing has borrowed $500 million US for such a facility. So they're basically churning out very large mega projects that are required for the transition. So that's where MDBs come in, like the Asian Development Bank, World Bank, and others. We can bring in the lending on sovereign and non-sovereign side, but also the technical assistance, the capacity building, and the kind of the convening power that we have by bringing together countries and governments across the region to work on these challenges.
Thank you, Vinny. And very important grounding for us that some of what has to be tackled is not just about capital structures, but it's also about the policy environment, the enabling environment. So very helpful grounding as we get going. And Mason, I'm going to turn to you. One of the things that most inspires me about FAST-P is they're trying different things. It's an umbrella to try different structures, see what works, see what is most catalytic. So I think what we're going to do now is hear from our panelists about some of the things that are already starting to work in this space, in blended finance. So Mason, if you'll kick us off.
Sure. First, a big thanks to the Singapore government for having me here today. And I'd like to share with you a story of success that we've had that started in 2019 and leading into COVID. That is a success story that actually starts with leading philanthropy, including one on this panel today, that decided to take a view of how do we go quickly to accelerate the low carbon transition when other investors are not there. And we started that journey with a fund called the Southeast Asia Clean Energy Facility. We reached our first close with less than 10 million, so very, very, very small. We then tripled the size of the fund. We brought on board investors like Microsoft and others. And I'd like to fast forward to where we are today with what the power of the missing P or catalytic capital can really do. Because while we actually hear about a lot of the challenges, what we see are a lot of successes when you actually have risk-neutral capital that can go about the low-carbon transition differently, and that's what we're all here celebrating today. So we're happy to note that as of today, one of our true norths is private sector mobilization. And some of you may be aware that MDBs and DFIs and even philanthropic funders generally have achieved about a 1 or 2x. So for every $1 or $2 that they put forward, they've mobilized around $1 to $2 of private sector funding. And this was the challenge that we looked to fill because based on our numbers, because catalytic capital is so precious, we think you need around a 500x from our numbers, around a 500x on that catalytic capital. So we've been making progress to see how we can achieve that. And we're happy to note that today, compared to a 1 or 2x that is average, we've already achieved in 4 years a 35x. So that's a combination of primarily private sector equity funding and follow-on funding, and later I'll explain more about how we look at it. But I'd also like to share with you where philanthropy is going with that first fund. We think we're going to hit 100x next year, and we're in the process of helping 4 of our portfolio companies raise debt. So we think that it's these success stories that we would want everyone here to walk away with, that when we can collaborate and work together, that we can actually achieve great things through collaboration. For us, we just look at the market differently and how we approach it. So we look at speed and scale. And we'll talk maybe a bit more later about where we have gone for our second fund, which is much larger.
Very inspiring. So going to 100x and then to 500x. So let's continue to celebrate some of the things that are working. Connie, maybe I'll go back to you.
Yeah, I was going to say, first of all, congratulations on that. That's very impressive. And I think we should take some of these lessons learned from what has worked in the market to other areas where it hasn't really been addressed before. So when we look at the market, especially in emerging markets, there has been many more blended finance equity funds trying to target, the project development phase, but there hasn't been so much trying to target on the debt side. And in emerging markets, after a project gets through that kind of project development equity phase, it's still required some financing that may require concessional capital to get them to a stage where they're fully bankable. So really thinking about catalytic debt and using some of the successes that have been that have worked well with catalytic equity to move into also looking at that bridge, that catalytic debt, where, for example, FAST-P is trying to target, right? The three funds are all debt funds, which is really exactly trying to address this next, stage in their development. And it's really a partnership with the equity as well as they move into that stage. So I think we can take some of the lessons of what's worked well to apply that same kind of structuring or technology, what is applicable to be applied into that next phase for that, catalytic debt as well.
I love that. And I heard you talk about Pentagreen yesterday. And that early in a project, after that very initial phase, getting in that catalytic debt to be the bridge before you can bring in more equity could be very, very impactful for that project and not dilute the initial shareholders in the process during those early days. So Elizabeth, let me come to you. What's working?
I love this, I have to say, Cindy, because this is a panel of hope and opportunity, which is not a lot of the panels I've gotten to participate in so far. So I really am excited about all of the values and the pieces that are coming together to make this happen. I think one bright light in our portfolio is something we actually created with MacArthur Foundation. It was called the Zero Gap Fund. We together put in about $30 million. And I was really excited about this because we had 12 different strategies in that, or 12 different investments, I should say, in that portfolio. And on top of that is exactly what you said, Mason, $1.07 billion of additional leverage on top of it. That, for us, is such a huge return on otherwise very small dollars from the Rockefeller Foundation. And one of the important investments in that, which is important to us as a climate-focused foundation, is women, and closing the gender equity gap, in particular around pay, which is over, 130 years right now, and that's just not going to work. And one of the investment strategies in there is actually a debt strategy that is focused on a women's livelihood bond that makes sure that women entrepreneurs actually have the access to capital to grow their businesses on the ground and make sure that they're more climate secure. And I was excited to see, I wish it was 100, but 7 times leverage on top of that on a very replicable structure. And so if we can help continue to catalyze capital and develop those sustainable structures that really benefit people on the ground, and those people in particular who are at the front lines, who don't usually get that chance to access to capital, I think we can change the world in an even better way.
Fabulous. Vinny, maybe a story from you. What have you seen work well?
Maybe I share one story from Lao PDR. That was the Monsoon wind power project, which was a couple of years ago, 600 megawatt cross-border from Laos to Vietnam, which had an improved PPA in Vietnam, but over the regular PPAs in Vietnam, but still curtailment risk issues for technical reasons were still there. So we managed, as a lead arranger, we managed to put together roughly just about $700 million in financing, which was a combination of regular ADB resources, B loans, commercial co-financing from commercial banks, and $60 million of concessional capital. There was a mix of the Japanese JICA's private sector fund, the Canadian private sector fund. ADB also has its own Asian Development Fund private sector window, which also contributed. And these 60 million, they were really they gave comfort to the investors. They were also put into an account in case there was issues would arise later. And the deal went through, and there was I think it's been the largest, at least at the time of financing, the largest wind power project in Asia, but I want to give a future, really, hopefully a successful case study that we want to talk in a few years about. That is Singapore's import of 6 gigawatt of clean energy from neighboring countries. And that is huge. This is, and we heard the ASEAN Power Grid was mentioned in the previous session several times. That is a huge project which is too complex for anybody to go alone. There are many governments involved. There are many, within each government, many agencies, many regulators, many utilities involved. There is, financiers are involved, the suppliers are involved, obviously the power companies are involved. That 6 gigawatt import from Singapore, I think, is triggering a lot of action that we have not seen before. And I think that's a case study we should all watch.
So let's watch for that. Hopefully we'll be celebrating that one soon. So anyways, excellent to hear these stories. And I think it is very, very important for us to also always zero in on things that are working, that can be replicated. So I think we need to broadcast that more. But let's turn to structural breakthroughs that could make an even bigger difference. So we'll often hear that in addition to the deal structures we have now, we also need system-level changes. We need multi-institutional collaborations that haven't taken place before. So I just want each of the panelists to comment on what structural changes and breakthroughs you would like to see. And after that, we're going to open it up to the audience. So please think about the questions you might have. But Mason, again, I'll start with you.
Sure. So when it comes to structuring options and the breakthroughs that we actually need, which we do need more monsoon wind projects in the region. And this is an area that we look to help through a blended fund structure, through CSEF2, our second fund, and a real warm thanks to some of our funders that are in the room today, is that we need the scale. So what philanthropy can deliver, of what I mentioned about before, was a small fund. But what we need are the partners just like ADB, the DFIs, the multilaterals. But more than that, we need the private sector capital to come into the room. So this is what we're seeking. And the way that we approach structure also is how we approach our markets in Southeast Asia, which we would hope we could leave you with, is that we see two shifts to the low carbon transition. One is, what can we do right now, today? Not before the regional ASEAN power grid is complete, that may take a while, but how do we actually make climate impact right now? And some of the ways that we do that with risk neutral capital or catalytic capital is to innovate low-hanging fruit or business models, whether that's commercial industrial solar, combined with energy efficiency, distribution grid. We can now mobilize capital with full commercial business models that do not rely on any regulatory changes. So if our secret sauce is how do we achieve it, is we go where there's no regulatory barriers. Now, this is wonderful. We can do that with philanthropic capital. However, is that going to get us to where we need to be for the low carbon transition? We need the trillions. So the second part of our strategy is to work and partner with the large capital providers. So that's MDBs and DFIs that are here today, because we're also there with you for the long run. So we're there to put the time and effort in at an early stage to unlock all those big opportunities. So this massive collaboration and the effort that we're undertaking with some support of our funders here today involves all of these different stakeholders to give us that scale to really lean in and go after those very challenging opportunities that we just couldn't do with catalytic capital because there's not enough of it. And so in that way, we look to deliver success in the future, both in the short term, say with growth equity, what we can do right now, but we haven't lost sight of where we actually need to go. So those are the two pathways that we're taking forward to really deliver for the long term, for the low carbon transition. And that can only be made through partnerships. And that's where we can get the best out of everyone at the table, because we need to mobilize technical assistance, government support, and many, many stakeholders to make the lasting transition.
Thank you, Mason. And I'm sure some of the other panelists are going to touch on the importance of these partnerships to take the more medium-term bets together and share some of that upfront investment in making some of these new areas of the climate transition investable. But let's keep going on structural breakthroughs. And Connie, I'll come back to you.
Yeah, so I think one of the things that's really important as we create more of these structures and hopefully create more successful examples is to really share the data, right? If we want to establish blended finance, concessional capital as a new asset class, we need to know how this asset class performs. What kind of impact is it making? So really having that data to encourage others to see the impact so that it can be repeatable, scalable is super important. The second thing I think would make a difference in terms of a system level, right? We're always talking about the shortage of concessional capital. And most of that capital is coming from public sector and also philanthropy, but the private sector can also think about creative ways to also lean in and get involved. Recently, Temasek had launched a 100 million Singapore dollar commitment for concessional capital for climate action. Now, Temasek, as a commercial investor participating in concessional capital, is outside of our mandate. But how we have looked at this in terms of kind of a new way to look at it is for the past 20 years, as part of our normal course, we set aside funds for community. And this is funds where whenever we have net positive returns above our cost of capital, there's some funds set aside for community good as part of our role as stewards of our community as well. This is very similar to corporates, putting aside a percentage of their profit for charitable contributions. So similar concept. But this year, in this concessional capital for climate action, this is the first time we're setting aside, this community gift for climate. So really encourage private sector to also think about, creative ways that they can also lean in, because the gap is very large and there's not, enough concessional capital out there.
I absolutely love that. What a great challenge to the private sector. Elizabeth, over to you. What would be some of the structural moves we could see?
Sure, happy to add on to that. One of the, just so that you understand our work, about 75-80% of our grant making a year, or capital deployment a year, goes into the emerging markets. And one thing that we've been wrestling with is that 48 countries that we work with have more debt burden and are paying more in debt service than they are in health and education. And that's just not a sustainable model. And so as we think about what we can do and how to deploy our capital differently, we're thinking a lot about, for example, energy, because it seems like the private sector is already going there. Private capital, obviously, we need more investment there. And so I just wanted to offer two examples, Cindy. One was something we created at the Glasgow COP called the Global Energy Alliance for People and Planet, because we wanted to make sure that the 800 million people who did not have stable and reliable access to energy actually could, because they couldn't be here today, and we couldn't be here today if we didn't. And so in doing that, we partnered with ADB, we've partnered with a number of private sector entities to figure out how to use that $1.5 billion of concessional capital that we have in the most catalytic way to drive outcomes for people on the ground. One of the things that we launched last year at COP as well was something called the Battery Energy Storage BESS. We had a cute pin that said, "Say yes to BESS." And the whole point there was to try to make sure that we created an opportunity so that people had access to battery storage, because one of the challenges that we've seen is that if you do them in such a bespoke way, you don't actually get good pricing. And through BESS, we've been able to have an aspirational goal of deploying 5 gigawatts of battery energy storage to these communities. What we've seen through our early work is that it both creates the demand incentive for developers to come in and reduces the cost by 30%, which is a tremendous opportunity for those communities to be able to participate in green energy and the modern economy. And so in so doing, we're using our capital in really flexible and different ways to help support procurement as a first loss guarantee, to help support and deliver on grant capital. And that's the kind of ways that we would like to see us and other philanthropies partner together with all of you to be able to deliver climate and people outcomes on the ground.
Thank you, Elizabeth. Vinny, maybe one structural change, structural innovation from your side that you're either seeing or would like to see.
No, thank you very much. I like a lot the partnership idea comes through, obviously. Maybe one big idea is from an MDB perspective, supporting Pathfinder projects. proof of knowledge, proof of concept that can then be replicated. I give you a couple of examples. One is we are working right now in Indonesia on the early retirement of coal-fired power plants. If that can, the first transaction, once the first transaction comes through, and we are in there because we can take some additional risk, and we have technical assistance and support and engagement with the governments concerned and with the private sector sponsors, obviously. I think that can then unleash investments in similar projects elsewhere. Number two, exhibit number 2 is also on energy transition and repurposing or early retirement of coal power plants. We're working in the Philippines on the refinancing of one such project through transition credits. Again, if the proof of concept works, that could unleash a whole new world, right? Because coal-fired power plants obviously are the issue. And the next pathfinder, and I come back to my previous point, would be the ASEAN power grid. If the first few connections can be added now, there are a number of connections, but if that can get the semblance of a grid, I think then things will follow. And if we can also crack the financing puzzle on the transmission financing, that'd be wonderful.
Fabulous. So we've heard about things that are already starting to work. We've heard about some structural changes that we might hope to see. I think we might have time for a couple of audience questions. So if there are any questions, please raise your hand, and there are microphones around. Any questions?
Hi, thank you. This was a very insightful panel. Really appreciate it. My question's more so directed towards Elizabeth. You brought up, championing equitable investments, which is one of our theses. I have a not-for-profit launched during Climate Week in New York with Deutsche Bank head of ventures as well. So Karen and I are very passionate about, the placement of talent in funds of funds, private equity, and venture capital as well. And I don't believe it's a pipeline issue when it comes to this conversation. So I'd like to open this question up to you, but obviously the rest of the panel, obviously Winfried as well, and everyone else. Where do you see, refinancing strategies, and when we talk about IP finance, right, and when we link it to talent and a country's G&I strategy, where do you see, the pathway forward when we talk about equitable investments?
Yeah, I think we didn't hear the end of the question. Could you just repeat the actual question? Yeah, I think maybe
I have an echo chamber with my own voice in my head. It's very unnecessary. Where do you see talent and IP finance moving towards, especially now that we have larger galvanizing of capital in terms of having diverse leadership when it comes to funds of funds, private equity, investment committees, and public-private capital?
Elizabeth.
Sure. I can take a stab at it. I hope I actually understand the question well, so I maybe would answer it in 2 parts. I think part 1 would be one of the things that I believe that grant capital can do is to actually build the talent pipeline that we need, in particular in emerging markets, around the energy transition, around so much capacity building that needs to exist to make sure that both the IP is there, but that it's actually native grown, if you will, homegrown. And then the second piece is I would add, and I think I'm answering your question. I'm sorry, I couldn't hear it so well. But within our endowment, that is a core part of how we're thinking about deploying our capital, certainly for the returns to make sure that we can continue to achieve and drive our mission, but also make sure that we do it as mission aligned. So, for example, one thing we did as part of our climate strategy was to make a net zero commitment. We are putting our money where our mouth is, realizing how hard it is to both identify the products that need to exist that make it climate positive, but also making sure that ESG and DEI and all of the acronyms that exist, that we make sure that what we invest in really aligns with our mission and our values. I hope I answered your question.
Maybe Mason, if you want to add to that.
Yeah, I think that this would be a pretty encouraging statement. The fastest growing subsectors are those that we actually see could have a huge gender outcome. and that's commercial industrial solar, energy efficiency, electric mobility, and the stats that we have are very skewed. So we take this approach quite seriously because we're looking for our companies to grow and scale. Generally, they're at about 3 to 5x per year. So with great returns, 20 to 40% equity returns that we're already seeing, but we need to take them to the next level. And the only way that we can do that is, for example, our first fund, I think we've already helped employ over 5,000 employees. Almost half of those are female. So we are very much aligned with the 2X challenge. But if we're going to hit our targets, we have to double, triple, quadruple down. So we work with all the same partners here for technical assistance, because our economic returns are only going to happen if we can bring the full labor force into these businesses. And so what you see from my perspective is full alignment on the fastest to scale, most profitable models for asset growth has to fulfill this objective.
So I've just been given the signal that we need to wrap up. But I want to say a huge thank you to our panelists. We've talked about things that are already working, things that could be built upon. We've also talked about structural solutions that are actually not that far away in the plans of these panelists. So a big thank you, Connie, Winnie, Mason, and Elizabeth, for joining us.
Thank you. Please join me in giving them a round of applause. Can I invite the panelists and also speakers on stage for photo taking?